Hi, this is Ed Brooks, and we're getting ready to start this webinar. Obviously, we're going to be covering sales tax and the major changes that come from the recent Supreme Court ruling that we call the Wayfair case. So this is a big change in how sales tax works in the entire United States. I think the media has probably presented this as an online retailer type of thing. It really isn't. It affects every company that sells a product. So let me repeat that. Every company that sells a product needs to be aware of this new rule. So we're just trying to get the word out, and hopefully today those attending and listening in will have a better understanding of how it affects their company. So with no further ado here, I'm going to turn it over to Emma Smith and Megan Wingbermuley, tax experts in our SALT group at DHJJ. So Emma and Megan, go ahead.
Okay, first we're going to start off with just kind of a basic what is sales tax and some history to kind of give you an idea of where this starts. So let's start with what is sales tax? So sales tax is a tax assessed on tangible personal property or services. Every state is different. For example, Illinois does not tax most services, but South Dakota taxes everything, every service, products, all of that. And every state is different with how they assess the rate. So, for example, Illinois is 6.25% for the state rate, and then the localities could be 0 to 4.75%. So you could have a total of 11% tax in Illinois, depending on what locality, county. There's all different types of different localities, and each state is different. There's a ton of localities in the whole country, and then every state has a different rate. Ultimately, the sales tax is assessed on the end user, so where the ultimate benefit is being received. Most of the time, it's going to be the mail-to address or where you actually purchase the product. Each state is kind of different on how they assess sales tax. For example, some states are destination-based, so that means the sales tax is going to be based on where the product goes. So it follows the product. California, Wisconsin are that. Usually, if you're selling online, it's going to be the bill-to address. And most states do destination-based for interstate commerce. So if you're an Illinois business and you're selling out of state, you're going to do it based on the locality. Another option is point of sale. Illinois follows point of sale, and that's after the Hartley decision kind of breaks it down to what is exactly the point of sale. So you have to meet 3 of 5 tests, or if you don't meet one of those 3, there's another 11-part test that you have to kind of go through. Basically, it's where's your employee located, and who has the authority to bind the customer and the retailer in the sale, where's the purchase order accepted, where's payment received or invoice sent, inventory located, and the headquarters. So if you meet 3 of those tests, that's the rate you're going to use. So if your main headquarters is in St. Charles, and that's where the sales accepted, inventory is held, that meets 3 of the 5 tests, so you would use St. Charles rate. But if you are selling to Elgin, you're still going to use the St. Charles rate if you meet that 3-point test. Next, we have what is use tax. So use tax is complementary to sales tax. It's self-assessed by the end user. There's very low compliance, which is why the Wayfair case kind of came about. You're usually going to pay use tax in your home state. So when you purchase something in Illinois and you don't get a charged sales tax, you should be assessing use tax on your individual tax return. Some other examples are, like I said, internet purchases, which we're going to touch on more later. Cleaning supplies for machines. That's really important when you're using a resale certificate or a manufacturing certificate, so you buy an item exempt. But if you're consuming that supply, then you should be paying use tax on that if you're not charged sales tax. And so it's just kind of what's consumed during your product or your process. And the rate in Illinois is 6.25%. So it's usually just the state rate of sales tax, what your use tax is going to be. So next we're going to jump into what is Nexus. So Nexus is the minimum connection with the state that you have for a filing requirement. Every state is different. Also, states can be different for income tax and sales tax. So just because you have Nexus for one doesn't automatically mean you have Nexus for the other. So it's important to understand that when we're talking about Nexus today, we're really focusing on sales tax. Income tax is completely different, and you'll have to view that separately for each state. So physical presence, that was really overturned by the Wayfair decision. Some states still have a physical presence standard. A lot of states are moving away from that and going to this idea of economic nexus. So economic nexus is the new standard. It's really where the ultimate benefit is being received. Are you benefiting from that state's economy? And if you're benefiting, then maybe you should, that's when you evaluate your nexus. Some states have set thresholds, and some states just say if you do any activity in our state. So Megan's going to touch on that here in a little while in more detail, but I kind of just wanted to give you a basic overview. Then there are some other types of nexus, and it's important to remember that if you have one of these types of nexus that I'm going to explain, or you have physical presence, that trumps having economic presence. So if you're still going in a state, you still have a sales tax because you have that physical presence. Economic is just if you don't have any other. So one of the other types of nexus is click-through nexus. So that's if you're a retailer or service provider and you have a contract with maybe a supplier or a affiliate or anything like that, and they have a link on their website that they can click to, a customer can click to and get to your website. And then that person gets a commission or some sort of commission or pay for that clicking through the link and the sale that's made from that. And then the other is affiliate nexus, which is what I kind of explained. So that's if you have a related party. So, and that could be expanded depending on what state. Some of them, it's even your installer. If you're using a third-party installer, that's enough to create a nexus relationship if you're contracting with that third party. The next two are kind of newer, and they've kind of are evolving right now with the new Wayfair, but there's still some states that follow the marketplace nexus and the reporting. So marketplace is when you have an online marketplace that operates its business in a state and provides either infrastructure, customer service, payment processing, marketing. If you have one of those or you provide that, then you're considered, or if you provide those, you're considered a marketplace provider. And there are certain states that require that you are registered to collect and remit sales tax, and or you have a reporting requirement. And that reporting requirement means that you have a notice on your website that the client or the customer needs to pay use tax, and it's also on your invoice that you need to pay use tax. And you also provide a summary of purchases to the state and the customer so that they know what they have to pay use tax on at the end of the year. Right now, Alabama, Arkansas, Iowa, and Pennsylvania all have either current or pending legislation to follow this marketplace nexus. There is also Washington and Minnesota and Rhode Island. They have had this in the past. With Wayfair, they kind of changed it, but with Washington, the threshold is $10,000. So if you have $10,000 and you're providing this to somebody, you need to be reporting. So that's really important to see how low those thresholds are. Minnesota and Rhode Island, they had 100,000, so they've kind of changed and said, okay, you just have to collect the report based on the new threshold. The other one that's very similar to this is reporting requirements. But this is pretty much just saying if you're a retailer and you meet this threshold, you have to report to the state who you sell to, how much you sell to them, and then you have to provide the customer a list of their purchases for the year and what sales tax would be assessed. Then also have notices on your website and invoices that use tax should be assessed. States that have current or pending legislation: Alabama, Colorado, Georgia, Iowa, Kentucky, Louisiana, Pennsylvania, Texas, and Washington. Again, most of these states, I know Pennsylvania and Washington are only $10,000. So if you sell and have a client or a customers that purchase more than $10,000, you should be reporting to the state who those customers are, how much they purchase, and what their ultimate sales tax requirement is. So this is kind of new, and those I don't see changing. They'll have the economic presence over 100,000, but if you're in between that 10 and 100,000, you may still have these requirements. So that's important to understand. And a lot of the states are sending out notices on this. I know Pennsylvania has been very aggressive. So another thing that I just want to kind of mention, because it's been in the news and it's an interesting take on the nexus, is cookie nexus. So that's when you store cookies on somebody's computer. So they click on your website and you start, monitoring their internet. It's considered a device on somebody's computer. So Massachusetts, Ohio, Rhode Island, and Connecticut all say that's a nexus creating activity. So that's just something to keep in mind and keep an eye out. Like I said, that's a newer idea of how nexus is created. So it's just something we'll continue to monitor.
This brings up, just for the listeners to emphasize again the obvious, everyone thinks it's a physical presence test that, hey, I need to have an employee there or equipment or inventory. As we're going to be talking about over and over, we need to eliminate that thought process. It really doesn't matter anymore. It's all going to be based on where do I ship my products, who receives my services. It's, so if you, and I've been doing this for 30 years, so it's just ingrained in me. That's how I look at things. So we do need to kind of remind you as we get into the details here, that is gone. So it really doesn't matter. Back to Emma's point about cookies and, all these little indirect contact within a state, it's really just a whole new world. And, of course, physical presence matters, but it really doesn't matter that much anymore. It's kind of your sales activity, and we'll get into that. So
next we're kind of move into history of how Wayfair came about, and then Megan's going to get into more of the details. First, Commerce Clause is probably something you've heard when you are listening on on the news. They're talking about it. What is Commerce Clause? So Commerce Clause is the authority to Congress to regulate interstate commerce. So that means there's kind of a four-part test that each law that's brought in has to be kind of evaluated. So the state may not discriminate against interstate commerce. States may not impose undue burdens. So that's reporting. Like I said, the reporting requirements have gone to a couple of Supreme Courts, and it's not seen to be undue by any state Supreme Court that's brought up to. Next, you have substantial nexus with the taxing state. That's now brought about with the economic nexus, like we just talked about. Is it fairly apportioned? This is making sure that there's no double taxation. So if the sale is taxable in California, you're not also paying tax in Illinois on that. And then is it fairly related to the services provided by the state? That's really, are they providing police, fire, all those protections that we're paying for that through our sales tax. So the Commerce Clause is just kind of some background that I wanted you to understand as we move into the case. And then next, as you've heard the Wayfair case, I'm sure you've heard some of these other cases thrown out there, and we just kind of wanted to give you a very basic overview of what these cases were and how you've seen our economy change and how the Supreme Court has ruled differently as the years go on, as technology advances and the economy as we know it has changed. It's not always brick and mortar stores like it was when these first cases came out. So National Bell Hess versus Department of Illinois. This Bell Hess was a Massachusetts seller. They shipped catalogs throughout the country. Illinois said that catalogs were direct marketing. It really came out that the Commerce Clause came in and that there was not substantial nexus because of the catalog, that you really had to have retail or physical presence for Illinois to impose sales tax. So it came out in ruling of Bell Hess, and they did not have to pay sales tax to Illinois. And that was in 1967. 10 years later came Complete Auto. This was where fairly apportionment came in, and that was because Complete Auto was actually moving vehicles across state lines. And Mississippi levied the tax for the privilege of doing business. Supreme Court came in and said they did not violate the Commerce Clause because those sales were not taxed in the other states. It was only taxed in Mississippi. So that kind of just goes back to, is it fairly apportioned? The Supreme Court and all these go through the Commerce Clause and make sure it kind of meets every test. And the big one that you've heard most is the Quill versus North Dakota, and that was in 1992. And this one really pushed the physical presence. So Quill sold office supplies via catalog. They had no employees or no locations in North Dakota. They are the 6th largest office supply company in North Dakota at the time. They had over $1 million of sales to North Dakota. The Supreme Court ruled that since they didn't have a third party or location, there was no physical presence, so sales tax was not justified. And it was an administrative burden to collect sales tax. Because back in 1992, it wasn't internet sales, it was all catalog, there wasn't this connection. So that's where physical presence was really tested in 1992. Now we're going to kind of fast forward to Wayfair, but just kind of a basic overview of the history. Supreme Court really in the past has always stuck with physical presence. That we see is overturned. Physical presence is your office, your warehouse, sales reps, employees, third-party installation. And states were losing out on tax revenue because of online or out-of-state companies. So that was a big thing, and this is why we've seen our economy change. So many people buy things on Amazon, and now you need this sales tax. Revenue is being missed on the states because they're buying it online because they're not being charged sales tax. Brick and mortar stores also had a competitive disadvantage because they had to pay employees. They're paying for locations in that state, where these online businesses don't have those expenses, and they're not having the burden of reporting and collecting sales tax. So now Megan's going to jump into present day.
All right, so now that we've gotten a great overview of the history, we're going to jump into present day. So how did this all come up? 41 states, 2 territories, and DC all wanted this overturned. So as you can tell, this wasn't just South Dakota going at it with the Supreme Court and going at it with Wayfair. It was almost every state in the United States wanted this overturned. And it's because they were estimating sales tax revenue loss of $8 to $33 billion a year amongst all the states. So all these states looked and saw, oh my gosh, we're losing out on almost $33 billion a year amongst all of us. South Dakota said in their court case that they estimate 48 to 58 million was lost each year. That's a lot of money. And you know, we all know states right now, especially Illinois, is not doing the best, and they are definitely looking to increase tax revenue in one way or another. And so this was definitely why a lot of these states said, hey, we want to be heard. We don't think this is fair. People aren't reporting this on their personal returns like they should be. Compliance is not that great. We want in on this action. So South Dakota said, okay, this is what we're going to do. They wrote new sales tax laws that actually contradicted Quill and Bellitas. They did it on purpose. They knew exactly what they were writing, and they purposely put these laws in place to show economic nexus. They said $100,000 of sales a year or 200 transactions, and they waited. And they waited until to see who took the bait. And Wayfair stepped up and said, we're going to do it. We're going to take the bait. We're going to say, not fair. We're going to challenge it because this does go against the Supreme Court rulings that we've had in the past that Emma just went over. So Wayfair challenged it. And it went through, obviously, South Dakota Supreme Court, and then made it up to the Supreme Court. And this wasn't the first time that since the latest Quill that states have wanted the Supreme Court to review sales tax rulings, but up until now, the Supreme Court has not agreed to listen to it, and they agreed to listen to this one. So we all knew back when they agreed to listen to this one that this was going to be a big deal because it took them this long to actually get there. So what came out of it? The decision, 5-4 ruling. So it was a pretty close ruling. It was in favor of South Dakota. They overturned. They actually said that they thought Quill and Bellitas was originally incorrect. It wasn't even saying in today's day and age that things have changed and that, you know, it's easier for these companies to abide by these laws. They actually said, we think we got it wrong. Back in the day when we ruled on Quill and Bellitas, we think that was the incorrect ruling, which is really huge. Kennedy even said that these out-of-state and remote sellers who didn't have to previously collect sales tax, they were basically tax shelters. And as we all know, that's a no-no. That phrase is a no-no. You don't go in that realm of tax shelter. That's not okay. So they view this as they were leveling the playing field for all businesses. So those brick and mortar stores that were obviously in state and would have to collect and remit sales tax versus those remote companies who did not have to collect and remit the sales tax, now they were leveling that playing field. So now we're trying to get on the same level and at least have similar costs across the board. Though they agreed to it, they remanded it back down to South Dakota Supreme Court just to make sure that the Supreme Court addressed the other test of constitutionality, which it did. I believe a couple of weeks ago they finally passed it and it's in place now. So they went ahead and got that going. While the other states actually didn't have to do that, they, ever since Supreme Court had their ruling, they were free to make their own laws, or even a lot of them had current laws in place waiting for the South Dakota Wayfair to get through. So what the Supreme Court said was there is stated thresholds that were reasonable. They said $100,000 of sales and 200 transactions was fairly reasonable, and it would constitute a substantial nexus. South Dakota also said they were not going to make this retroactive. They were not going to go back past years and try to collect past tax, which then would obviously put companies at a disadvantage because they would not be able to go back to their customers and collect that tax. So Supreme Court said that's fair. We're not making this retroactive. We're going to go prospectively with this. And they're saying there's no undue burden on interstate commerce due to the software that's available out there. There's a lot of companies out there right now who offer services that can connect with your current QuickBooks or accounting software that can help track these sales and help charge the right sales tax rate and everything. So they agreed that that was part of their decision, that there's software out there now that's available and makes it easier for companies. And then finally, South Dakota is part of the streamlined sales and use tax. So there's 20 states in this streamlined sales and use tax, and basically they've made it a simplified filing and rate structure where you can log online, register for all the states, and additionally file the tax throughout all the states on this form. And so they argued that this made that easier as well. So they were, again, alleviating the burden on these companies. And the streamlined sales and use tax also offers some sort of software that actually is paid by the state to help with the sales tax filing. So that all said, how does this affect your company? So as Ed previously mentioned, I know the media has made this out to be solely about online business, which it definitely affects online sellers, absolutely. But the thing to note is this is not just about online sellers. This is about any company that is selling out of state, that is shipping things out of state. Common carrier, don't step foot in the state, don't do anything else in the state. Maybe they're not doing it online, they're doing phones or, whatever the case may be. Then this actually affects any out-of-state company that sells over certain thresholds that certain states set in place. So again, no physical connection is required any longer. And the thing to note here is there's over 10,000 taxing jurisdictions in the United States right now, which is a lot. So understanding the taxability of the transaction in each state is really important. Actually, in the Supreme Court ruling, in one of the dissenting opinions, I think it was Ruth Bader Ginsburg actually said that states can't even be on their own same level with understanding taxability of transactions. It's so complicated within a specific state, let alone across the states. Like in Illinois, for example, Twix is considered a food because it has flour, so it is taxed at the low food rate, but Snickers apparently does not have flour, so it is considered candy and taxed at the higher sales tax rate. So take that small example and spread that across 50 states. So it can get very confusing and a lot of information that you need to know and be aware of. And then there's multiple rates. As Emma previously mentioned, the destination versus the point of sale apportionment. destination is probably the majority of all the states that do charge that, is the destination base. So that's state, county, city, district, all compounded, and it's to each of the specific locations that all of these items are going into. So California, you could have hundreds of sales tax rates that you have to keep track of.
So Megan, back to that point then, that's kind of where that software comes into play.
Exactly.
So hopefully the software, I think a lot of people use payroll services. So we're hoping that there will be sales tax software that is similar to a payroll service where you can rely on them to help you administrate. And then also to the point of, who does this apply to? And I know I said everyone. It really does probably apply to every business. I can think of a type of business they don't have to worry about it, and that would be a retailer on Main Street. Your typical Main Street retailer whose only customers are walk-in customers, and they don't ship out of state.
Right.
So those are companies
there's definitely some exceptions to that, but in today's day and age, there's still even a lot of companies who do sell online, even small companies.
Well, even your Main Street retailers often have an online presence.
But then it's a matter of just reviewing your sales and seeing where you're at with these state thresholds, because every state has different thresholds set up. So that's where you need to get your information in order and your trusted CPA on your side to help you.
Yeah, and ship to, we're spending a lot of time talking to our clients about running sales reports by ship to address. So we talk about destination, that's just another way of saying ship to. So hopefully, and I find this to be the case almost all the time, is a company can generally run a sales report by state based on a ship to address. If not, that's a report you're absolutely going to have to comply.
Absolutely. Yeah, one of the biggest parts of this is having the information to be able to analyze it in the first place with your company. So, and the only other thing I wanted to mention with all of this is, obviously, if you start having nexus according to these standards in states, you're going to have to get the proper state registrations in order and exemption certificates. So just one thing to note, you could be having retail and wholesale. We have a lot of clients who do retail and wholesale. And even in their wholesale, it's a combination of the two when you're looking at the sales thresholds. It's not just the retail sales, it's all your sales according to these states. But also for the wholesale, now you're going to need to make sure you have certain exemptions on file. So your normal resale certificate that you've been getting on file for your Illinois customers, now we need to make sure you're getting them on file for your other ones, Indiana, Wisconsin, Washington, all over the board, because again, it's a paper trail. You want to make sure that you have all that information on file in case of ever, hopefully not, but an audit, you do have that proof that it was a resale situation or for an exempt agency like a governmental agency or not-for-profit or something like that. So those are all things that, we definitely suggest our companies and our clients to keep aware of, because even if you might not have to charge sales tax, there's just certain paperwork you have to have on file to protect yourself. So these are the states as of last Thursday. Granted, this gets updated daily. I don't believe there has been any updated since, but disclaimer, this was updated last Thursday. And states are all coming out. These states all had either current or pending. Some of these are pending, waiting approval. Some sort of economic nexus or this South Dakota Wayfair interpretation into their own law for sales tax. So all of these states have something either currently happening, has a future date happening, or is waiting approval by their lawmakers. So just to name a couple here, some thresholds to give you a thought. Most of these states have stuck with 100,000 in sales or 200 transactions, like Indiana and Iowa. Tennessee, for example, has $500,000 of a threshold. Wisconsin is also in the 100,000 or 200 transactions. So Washington and Pennsylvania, and again, I say this because it's very important, and Emma mentioned this before, but I do think this is really important to touch on. These two states have this $10,000 reporting threshold. that they put in place earlier this year. Washington has put in 100,000 or 200 transactions of sales to have to file starting October 1st, but they still kept their reporting threshold in place of 10,000, which is not very much in sales. And when you look at the reporting requirements, it's actually kind of daunting. And I think they purposely do that. I think they purposely put these reporting requirements in place to, what happens is if you're over 10,000, there's certain requirements you have to do for reporting, or you can just voluntarily sign up and start collecting and remitting sales tax. And I would say majority of people do that because the reporting is actually more of a hassle than signing up, collecting, and remitting at this point. So, and I think that was their goal. I think their goal is to obviously have more people actually sign up and register, but they couldn't say that before now. So they said, or you could do this reporting requirement. But the reporting requirements are kind of a nightmare when you look at them. You have to report on every single sale to every single customer in a certain format, certain verbiage. Then at the end of the year, you have to give them a summary. You have to give the state a summary and give all of their information. It's kind of messy. So that's why I wanted to touch on that again, because that is such a low, $10,000 is such a low sales threshold. So it's just something to keep aware of.
And another thing that I want to make sure you guys understand is the $100,000 is gross sales. That's really important to understand. It's your gross sales. So even though they might not be taxable, they might be exempt, it's still, if you meet that $100,000 of gross sales, then you have that requirement.
Right. And then wholesale,
retail, yeah, all of that. And it's before discounts, anything like that. So it's really important that you're maintaining your records accordingly. And also another thing that's really important is each state looks at their time frame differently. So some states are looking at, okay, it's based on your prior year. So if you met that threshold in 2017, you have a filing requirement for 2018. Or some states like Illinois it's a rolling quarterly basis. So every quarter you look at the prior 4 quarters. So that's really important to kind of have an understanding is, are you looking at the right period? Are you pulling the reports for last year and this year and seeing where you fall in these thresholds? So if you met it in 2017, then you should probably start looking at registering and getting ready for 2018 before it even comes. Like I said, each state is different, but I would say a majority are looking at either the prior or current year. So if you meet it in the prior year, you're going to have the requirement, and then in the prior year.
Okay, so your action slide, keep accurate records with ship-to address. Again, most people can pull that information up and have that information, but it is really important to make sure that it is. A lot of times people fill in the bill-to information, but don't fill in the ship-to in their system, so that's important to do as well. Updating your current procedures just to make sure all your procedures are in place to collect certain paperwork like the resale certificates and things like that. Make sure you have the delivery method and things like that, or if it's shipping out of the country completely, you want to make sure you have the correct information showing it's getting out of the country. Touching back on what Emma said, again, reviewing your annual sales source by state, and every state does this a little differently. Some states like Illinois is quarterly, the rolling 4 quarters. Some states say a rolling 12 months, some states say the previous calendar year or the current calendar year. Things that you just need to be aware of because every state measures it a little differently. And then you just want to review for other types of nexus besides economic as well. So this is the new thing and what we're here to talk about, absolutely. Just be sure that you're not creating nexus in other situations as well because those haven't necessarily gone away. This is just added to it. So there's still the click-through, the marketplace, affiliate, and those reporting requirements that we touched on.
So some other action items that, people need to keep in mind, I would suggest some training. Training your sales team, whether it's in-house sales, order processing people, maybe your salespeople. This is going to be something they have to take into account when they're doing proposals and estimates. So there's an education process involved. We certainly can help with that.
We've done it for a couple other of our current clients where I go in and I do a presentation to their sales staff, what needs to be on file, what's taxable in that state, what's not taxable in that state. And it was very well received. So the sales staff, they're the first line to the customer. They need to understand if shipping's taxable, if handling's taxable, if a service, if installation should be taxed, and what rate. So it's really important that your sales staff understand this law too, not just the people doing the accounting.
Yeah, and then also on the purchasing side, so your people that are handling accounts payable are going to get invoices that may or may not have sales tax on it. In fact, I think they should expect to get invoices with sales tax on from their vendors that they didn't get sales tax on before. And they need to understand, should I pay that tax, or do I need to go back to my vendor and provide some documentation? So, you know, that's just another part of it, part of the process.
And then for manufacturers and distributors, you might be getting asked questions now for additional certificates, or, you know, more states. If somebody you're purchasing from is filing in more states, they may ask for different exemptions and things like that. So you want to make sure that you have your own files up to date with the right states and everything that you will have Nexus in.
Maybe go back to that streamlined, that 20-state group that's part of that streamlined program. I just saw something the other day from one of my distributor clients who's shipping into a state. They don't have a physical presence there. Now the customer is saying, or one of the vendors in a three-party transaction is saying, can you give me a resale certificate? Right. And that streamlined thing came up. So I'm thinking part of the solution when you sit down, every case is different with each customer, but I can see for a lot of companies that are going to have to deal with multiple states, maybe just signing up for the Streamline program to get 20 states covered in one process. Does that seem like a real practical?
If you have enough sales in those states, but the important thing to note with the Streamline sales and use tax is you have to file in all 20 of those states. You don't have to pick and choose. If y'all 10 of them, it's all of them. So you have to be really committed to be able to do it in the first place. And if you have enough sales that are spread throughout the country, then I think it makes sense because it simplifies it. But if maybe you really don't have a lot in the majority of those states, then you have to know that the streamlined sales and use tax are not going to include the big states. You know, we're not including New York or Texas or Illinois or California, because all of those obviously want to do their own thing. They don't want to be part of that. It's going to be the small states, which again, you might absolutely have Nexus in. Now with these new thresholds, you might be over certain thresholds, and it's a great opportunity if you make enough sales. I think in majority of those 20 listed states, there's an online site that you can visit that lists those 20 states, or you can let us know if you need help locating that. We can absolutely find that for you and send that your way. So it's a great opportunity, I think, if you have a lot of sales in those states. If not, then it might be easier to pick the 3 that you might actually have certain sales.
So the real action plan to get ready,
yeah,
because everyone needs to get ready, is to probably have some sort of a sit down with an expert in this area. And I'm going to say, yeah, sit down with your CPA firm. But, and this is a big but, you know, a lot of firms do not have the expertise to deal with large multi-state issues. So, you know, make sure you're working with, of course, we're happy to help. This is something we spend a lot of time on. But you got to get it right, because there is high risk and high potential liability if you don't comply. If you say, well, let's see if they, you know, catch this. Well, if they do come in and they audit you 4 years later, I mean, the liability could be huge. You know, you're looking at, if it's $100,000 in sales, 7% average rate at $7,000 a year, plus penalties. It's one of those liabilities that if you don't address correctly in the beginning, just can build up for years. And when you do get the phone call, it's a problem. The other issue is you might have a company that you're looking to sell someday, and they come in and they do the due diligence, and they realize you have not addressed this issue. There's hundreds of thousands of liability, and they don't want to touch your company with a 10-foot pole because of, you know, this hidden, built-up liability. So we can't put our head in the sand, so to speak, on this topic. It's not you know, probably the most exciting thing for people to deal with, but, you know, we have to watch out for our clients, and you have to watch out for yourself that you are not missing something that can really hurt the company down the road.
Great. Thank you guys for joining us today.